Dear colleagues, ladies and gentlemen, on behalf of the Insurance Law Special Interest Group at the European Law Institute, it is my pleasure to welcome you to the 10th ATILA lecture. As indicated in the program, we will be dealing with the EU's new retail investment strategy from a comparative perspective. I'm delighted to welcome 3 speakers on this topic, all of whom are proven experts in the field. CHRISTOPH BRÖMMELMEYER is a professor of law at the University of Frankfurt, Oder, and he's a recognized scholar of insurance law, especially in Germany, and also a member of an advisory council to the German Insurance Supervisory Board. CHRISTOPH will give us an introduction to the retail investment strategy of the European Union. A critical view on this retail investment strategy of the EU will be presented by KAREL van HULLE. KAREL is former head of insurance and pensions at the European Commission. This is why I like to call him Mr. Solvency II. And he also teaches as an Emeritus professor at the Catholic University in Leuven, Belgium, and as well as a honorary professor at the Goethe University in Frankfurt am Main. KAREL, very welcome. And finally, a comparative look will be presented by Daniel SCHWARCZ, who is a professor at the University of Minnesota Law School and a recognized scholar of insurance law in the US. His focus will be on the most current issues presented by generative AI and robo-advisors. To our guests, let me instruct you that any remarks or questions from your side are welcome in the chat. The speakers will try to comment or answer your remarks or questions at the end of the presentations. Dear speakers, I thank you so much for your willingness to contribute to ATILA. And CHRISTOPH, the floor is yours. You are muted, CHRISTOPH.
I'll try again. Thank you very much, Helmut. Right now, do you hear me and do you see me?
I hear you.
And you see me and you also see my slides? I'm sorry, do you also see my slides?
No, but I will open them for you. There we go.
Okay, will I be able to move within the slides then?
I don't think so. You just tell me.
Can we, I'm sorry, can we try that again at least? Because I would love to do it by myself. I'm sorry. Just send the question.
So I stopped the sharing.
Okay.
You try it again.
Yes.
Yes, now we see it. You have to start the presentation.
There you go. Thank you very much, Helmut, and thank you very much, everybody, for your patience. It is a privilege, of course, to share my thoughts on insurance as an investment. My job today is, Helmut has already mentioned it, to introduce you to the retail investment strategy of the European Union, and that is what I'm about to do. So what is the retail investment strategy? Since this strategy comes from the European Commission, it is probably best to ask the European Commission. So here is a policy statement by the European Union, by the Commission, May 24th, 2023. Today, the Commission adopted a retail investment strategy that places the consumer's interest at the center of retail investing. The aim is to empower retail investors, that is, consumer investors, to make investment decisions that are aligned with their needs and preferences, ensuring that they are treated fairly and that they are duly protected. This will, according to the Commission, enhance retail investors' trust and confidence to safely invest in their future and take full advantage of the EU's capital markets union. So this apparently is a policy statement. It's all about trust and confidence. It is about a safe environment to invest it is about consumer protection. Now, let's take a closer look at the idea of empowering retail consumer investors. The Commission finds that retail investors struggle, this slide has it, to access relevant, comparable, and easily understandable information to make informed investment choices. The Commission believes that retail investors are increasingly at risk of being unduly influenced by social media. The Commission believes that financial advice may not always be in the best interest of retail investors, and the Commission observes that some investment products do not always offer value for money to retail investors. Now, the Commission, being the Commission, does not only see the problems, the Commission also provides the solution. This is what the Commission is about to do. The Commission proposes to modernize disclosure, to develop benchmarks against which the value of financial products need to be assessed, and to address potential conflicts of interest by banning inducements for execution-only sales and by strengthening conditions where inducements are allowed. These measures obviously require new rules, so the European Commission, the European Parliament, and the Council will have to realign European insurance law, will have to set new regulatory standards. So that's why the Commission proposes two new legal instruments. There is a proposal for an omnibus directive of the European Parliament and the Council, amending a number of directives as regards the Union retail investor protection rules. And there is also a proposal for a regulation amending the PRIPS regulation, which has to do with a so-called key information document, or KID. I will focus on the omnibus directive. I will talk only about the directives and about amending these directives. Now, you may not be familiar with all of these directives. There is, for instance, the UCITS, which is a directive on undertakings for collective investments in transferable securities. You may not be familiar with AIFM, which is a directive on alternative investment fund managers. But you would certainly be familiar with Solvency II, being the most important directive there is in insurance. And you will, of course, be familiar with IDD, the Insurance Distribution Directive. So what we see is a mixture of directives. Some belong to the financial markets and some belong to the insurance markets. But so far, I've basically been talking about investments, so I suppose you will be glad to learn that today's lecture is about insurance policies. However, the Omnibus Directive does not concern all insurance policies. There is a clear key to insurance as an investment, and that is the idea of an insurance-based investment product. This is the definition. Article 2 of the Insurance Distribution Directive provides the definition, and it looks as if the new Omnibus Directive is not going to change the definition. According to Article 2, insurance-based investment product means an insurance product which offers a maturity or surrender value where that maturity or surrender value is wholly or partially exposed directly or indirectly to market fluctuations and does not include a non-life insurance products, and then a number of other exceptions which do not fit on the slide. So I will focus on the first part of the definition. Key is the maturity or surrender value and the idea that this value is exposed to market fluctuations. Now, there is an ongoing discussion what exactly insurance-based investment product means in terms of the products available within the European Union, the products available on the European market. There is a consensus that unit-linked life insurance policies are insurance-based investment. And there is a discussion, for instance, if endowment policies, which used to be very typical insurance products in Germany, are covered by this definition or not. However, the German supervisory authority, BaFin, has long since made up its mind. So today, endowment policies would be covered, at least from a supervisory point of view. So this is what we're talking about from an insurance point of view. It is about insurance-based investment products and new rules set out by the directive as regards retail investor protection rules. Now, what is the state of play when it comes to the Omnibus Directive? Right now, as we speak, probably, there are interinstitutional negotiations going on between the European Commission, the European Parliament, and the Council. There even is a term for this. It is the, in the end of the day, informal trilogue. And as the three institutions are negotiating now, we have three different versions of the Omnibus Directive which are on the table. There is the proposal by the Commission, May 24th, 2023. There is a resolution by the European Parliament on April 24, 2024. And there also is an agreement within the Council of the European Union, June 12, 2024. So we have three different versions of the directive, and we don't know yet how the final version of the Omnibus Directive is going to look like. So what I would like to do is, I would like to give you an idea of the content and of the differences between the three versions of the envisioned directive. And I focus in this case on the inducement. One of, I think, the key areas of the new directive is the regulations of inducements, also referred to as commissions or retrocession fees. Now, there is a distinction between inducements in case of insurance distribution and execution only, and insurance distribution in case of independent advice. Let's take a look at execution only first. The European Commission had a, I think, very clear message. In case of execution only, there should be no inducements, no third-party payments whatsoever. The insurance intermediary who does not advise his clients should not have the right to ask for any commissions whatsoever. However, European Parliament and the Council don't agree both of them are saying right now, don't ban these inducements. And the Council is maybe looking for some middle ground and points out that we should not ban inducements. However, we should make sure that insurance intermediaries comply with a certain so-called overarching principles when it comes to inducements. My impression is, but I might be wrong, that the ban on inducements in case of execution only is pretty much off the table. So please do correct me if you know more, but that is my impression. So I will focus on independent advice, and I would like to go into this in more detail. Take a look at the next slide. And first of all, at the proposal of the European Commission. There you will find that member states shall, according to the Commission, require that where an insurance intermediary distributes insurance-based investment products, informs the customer that advice is given on an independent basis, the insurance intermediary shall not accept and retain fees, commissions, or any benefit paid or provided by any third party. So again, there is a very clear and unambiguous message by Commission. If you claim that you advise independently, then you should not have the right to accept or retain a commission. The European Parliament agrees. You will find the same wording in the Omnibus Directive according to the European Parliament, but then you also find a clarification, in quotation marks. This paragraph, that's European Parliament, puts forward, shall not prevent insurance intermediaries whose legal status qualifies them as independent from presenting themselves as not contractually tied to a specific insurance undertaking if they indicate that they receive inducements. Now, I believe that is not quite as unambiguous as the message of the European Commission. So what does it mean? Apparently, there are insurance intermediaries which are legally independent, or who at least believe that they are legally independent. And they shall have the right to receive inducements as long as they don't claim that they give advice on an independent basis. Now that is, in German you would say, ein schmaler Grat. There's a very fine line. So there are going to be insurance intermediaries, in this case, insurance brokers, which are going to say, we are independent and we still receive inducements. We are independent, however, we don't give advice on an independent basis, because if we would say so, we would not be able to receive inducements. So I'm not sure how this is going to work out, but that is the message in this case. Then we have yet another wording in the Omnibus Directive according to the Council. This paragraph shall not prevent insurance intermediaries that are not employed by or contractually tied to an insurance undertaking, but receive inducements from the insurance undertaking and that fall within the scope of Article 21A from presenting themselves as not contractually tied to a specific insurance undertaking. I'm not sure, ladies and gentlemen, if that is the same message as the message of the European Parliament, or if this message is entirely different. We will see. But I think that the important message from me is there are still distinct differences, and it will be interesting to find out how the final version of the Omnibus Directive will turn out. Now I'll just take a look at my watch. I'll need another 2 minutes. I'll try to. Just one quick view at Article 12-A of the IDD according to the European Parliament. The European Parliament proposes that EIOPA, the European Supervisory Authority, shall develop common European benchmarks for groups of comparable insurance-based investment products, serving the sole purpose of a supervisory tool for national competent authorities, which is to say the national supervisory authorities, in order to identify potential outliers among insurance-based investment products. The idea is national competent authorities may identify products that deviate from the benchmark, and they may require the insurance undertaking to provide an explanation for that deviation, to correct its approach, and to provide the consumer with the intended product, and as a last resort, to remove that product from the market. So we have two key features of the Omnibus Directive, inducements and value for money. Maybe we will see this benchmark approach in the final version of the directive. And my last slide already, the conclusions. The retail investment strategy basically is a project of the Capital Markets Union. It's first of all about financial markets rather than about insurance markets. The retail investment strategy also is a moving target, at least when it comes to the exact version of the Omnibus Directive. The retail investment strategy, the Omnibus Directive, might be a step back, and a reasonable step back at that. If you look at the last, let's say, 30 years of insurance regulation within the European Union, you will find that 30 years ago, we had a liberalization of the insurance markets. There was a third directive on insurance regulation, life and non-life in Europe, which led to a liberalization. Before that, there was a preventive product control. After that, there was only transparency and information. And there was a lot of information. Some of us will claim that there was an information overload. However, by now, everybody realizes that all this information did not prevent potential customers from making wrong decisions. So today, if we're talking about benchmarks as a supervisory tool, this might be a cautious return to product control, even though it would not be a product control ex ante, but product control ex post. Final remark, you could also claim that the Omnibus Directive is yet another step in the wrong direction for a very simple reason. Many, let's say, consumer protection groups claim that we should take an entirely different approach. We should separate insurance and investment. It should be illegal to combine these two, let's say, promises within one and the same product, because the combination of the two leads to complexity, and all the transparency and all the information will not help, because customers will simply be incapable of really understanding these products. They are simply too complex. So I'll leave it at that. Thank you very much for your attention.
Thank you, Christoph, for this wonderful and very insightful overview on the legislative proceedings that are going on. And with your last slide, as you called it, with a smiley, you already indicated there is criticism out there, that there's a critical view. It could be even viewed as a step back or as a reasonable step back, and probably a wrong step. This is why I will now give the floor to KAREL van Hulle, who will, as promised, take a critical view on these legislative developments. And KAREL, we will now present your slides and
okay.
Ask you to start your presentation.
Yes. Thank you very much, Helmut, and good afternoon, ladies and gentlemen. I am very pleased that Christoph introduced the topic because it is of some complexity. And in fact, I can speak out of experience. Regulating is a very difficult exercise. There has been a lot of regulation in financial services since the financial crisis in 2008 and 2009. Some people are now pleading in favor of deregulation again. This is not dissimilar to what we saw after the capital market crisis, the beginning of this century. The avalanche of regulation that followed the demise of Enron was followed by a wave of deregulation under the motto, more is less and less is more. That deregulation was partly responsible for the banking crisis in 2008 and 2009. Are we going to make the same mistakes again? Have we not learned about how to regulate? And that is the reason why my approach to the retail investment strategy is one about how to regulate. And I believe, unfortunately, that the retail investment strategy is a good example of how not to regulate. So let's go on to our next slide, Helmut. Search for the Holy Grail. As Christoph rightly put, the retail investment strategy has to be seen in the framework of the Capital Markets Union. It has been shown at multiple occasions that EU citizens, even more so since the UK citizens left the EU, are reluctant to invest their savings in EU capital markets. Citizens prefer to keep their money in bank accounts, even though it's quite clear that the low returns they get on these accounts are eaten up by inflation. In 2021, for example, approximately 17% of the EU 27 household assets were held in financial securities, listed shares, bonds, mutual funds, and financial derivatives, as opposed to 43% by households in the United States. So that is a considerable difference. Realizing a capital markets union has therefore been a very important objective for the EU since the adoption of the Capital Markets Union Action Plan in 2020. It is recognized that ventures such as the European Green Deal can only be realized when more money is channeled to the industry through European capital markets in order to fund the important investments that are needed for the transition to a carbon neutral economy. More capital is needed to finance the climate transition, to invest in digitalization and innovation, to finance startups, scale-ups and unicorns who need investment, and to drive economic growth and job creation. That's a message that came out very clearly in the recently published reports by Letta and Draghi, who observed, by the way, that it is cheaper and more attractive for EU citizens to invest directly in the US capital markets than in EU capital markets. In order to make it quite clear that this objective is important, the new Commission President, Ursula von der Leyen, has indicated that one of the Commission's most important objectives for the next 5 years will be the realization of a thriving savings and investment union. Now, why do European citizens fail to invest in EU capital markets? Besides the general issue of financial literacy, or lack of it, there are a number of reasons that have been stated in the Letta and Draghi reports. It is too expensive to invest in European capital markets for a number of reasons. There is too much fragmentation. Industry is too dependent on bank financing. There is a lack of competitiveness. There are too many intermediaries in the process. Too many people and institutions are in favor of a status quo. There are too many levels of supervision, and there are too many monopolies at national level. In the Commission's explanatory memorandum to the risk proposal, a number of issues were also highlighted. Problems that retail investors face, and Christopher has mentioned those. Difficulties accessing relevant information, the influence by unrealistic marketing information, shortcomings in the way products are being manufactured, and unjustifiably high level of costs. In preparing the risk proposal, a lot of focus was put on inducements, which financial intermediaries receive in order to promote the sale of retail investment products. Examples were given of situations whereby the investment return on a retail investment product was completely spent on commissions paid to the intermediary during the first years of the investment. And therefore, Christoph already mentioned that the magic solution invented by the Commission was a ban on commissions. In the mind of the responsible EU Commissioner McGuinness, the risk would ensure that retail investors are empowered to take more informed investment decisions that better correspond to their needs and objectives, and that they are adequately protected in the single market by a coherent regulatory framework. This would enhance the trust in the market. Now, will more regulation solve the problem? That is the question. Regulation will only do so if it is properly designed. And I'm afraid that this is not the case with the risk. There is, as of now, no single market yet for retail investment services because of the existence of multiple structures at national level which prevent the creation of a truly European capital market. It is therefore inappropriate to introduce EU legislation that starts from the premise that everything is the same in all member states. No one-size-fits-all approach for all products in all markets is justified. Furthermore, most European citizens are not yet convinced that they need to invest their money. There is a fundamental belief that in the end the state will cover all risks. There is therefore no need to save for an additional pension, for instance. And as far as capital market investments are concerned, this is believed by many people to be mainly in the interest of financial intermediaries. Bringing EU citizens to investing in the capital market will require more than just legislation. The investment must be made more attractive, for instance, by providing fiscal incentives. Next slide, better regulation. After the avalanche of regulation following the banking crisis in 2008 and 2009, the EU was proud to come forward with guidelines on better regulation. It was believed that better regulation would in the end produce better outcomes for all parties involved. In the end, any legislative action by the EU legislator is subject to the limits on the exercise of competences enshrined in the Treaty on the European Union. The principle of conferral, the EU can only act when it is empowered to do so. When the EU is empowered to act, it has to follow the principles of subsidiarity and proportionality. Subsidiarity means that action is only justified when at EU level action is better than at local or regional or central national level. Under proportionality, the EU can only act in the framework of what is necessary to achieve the objectives of the treaties. As part of this better regulation agenda, the Commission has committed to include in the explanatory memorandum that accompanies its legislative proposals a more thorough explanation of how the initiative meets the twin tests of proportionality and subsidiarity. It must also include a thorough impact assessment. Is the risk now a good example of better regulation? It cannot be said that the risk proposal is not accompanied by an explanatory memorandum, which indeed sets out the respect of the principles of subsidiarity and proportionality. However, if you look at the justification, it's just 2 paragraphs for each principle. And it looks more like a statement of fact than a justification. Similarly, the very extensive impact assessment is not convincing in a number of respects, particularly on inducements. It is very difficult in horizontal legislation, of which this is an example, very difficult to give full recognition to the principles of proportionality and subsidiarity, as too many issues need to be taken into account. This is equally so for the impact assessment. The very extensive impact assessment is therefore not convincing in a number of respects. For instance, on inducements. And I mention inducements because, as Christoph rightly said, it was the clear intention of the Commission to introduce a ban on commissions in all financial services areas, not only retail investment, also in insurance. Proper research on this for all member states would have required extensive work and would most likely have concluded that there was no need to do so. Risk, a failed approach. Next example. Next slide, please. If the intention is to make retail investments more attractive, consumers should not be confronted with additional bureaucracy. It has been said by the insurance industry that completing an advised sales process for a green IBIP, insurance-based investment product, under the current IDD rules already requires 1.5 or 2 hours of consumers' time. The risk would add more time to that. By introducing a broad ban on inducements, the risk makes it difficult for consumers to take investment decisions without having to pay an upfront fee, something that most consumers would not be able or be willing to do. Similarly, rather than to simplify the disclosures, the risk adds further information to an already large quantity of information that needs to be provided. The Council and the Parliament added, by the way, some more disclosures. The process of continuously increasing information without a holistic approach is clearly not helpful. Let's move on now to risks and insurance. So the next slide and the next slide. Next slide. Yes. Okay, thank you. The debate about retail investments fails to recognize that traditional insurance products are also insurance products and not just investment products. The insurance industry and insurance supervisors have difficulties in explaining this to asset managers and to security supervisors. The risk is again an example of a failure to recognize this. Even more striking is that the risk simply extends the new requirements for retail investments to non-life insurance. This is done without any impact assessment, and it is all the more surprising as non-life insurance products such as motor third-party liability insurance or home insurance are clearly not investments. There is no reason why non-life insurance should be part of a risk proposal. Of particular importance in the risk is the introduction of the concept of value of money, and Christoph already elaborated on that. Both EIOPA and ESMA have been working on this for some time as part of the further development of the concepts of product oversight and governance, which were introduced by the IDD. Would it not be much better to leave EIOPA developing these benchmarks as part of a further implementation of the POG, rather than now introducing benchmark potentially as a legal requirement, resulting, as Christoph rightly said, in a risk of product control as a result of that? Last slide. Lessons learned. There seems to be a growing feeling that the risk was, after all, not such a great initiative, and that it should be brought back to the drawing board. It remains to be seen what Council and Parliament will develop in terms of the trilogue, which I understand has not yet started. Meanwhile, EIOPA and ESMA have already urged the co-legislators to refrain from adopting new legislation when the European Commission is planning to come forward with new initiatives as part of its new savings and investment strategy. We need to avoid continuous changes of legislation. And to conclude with Einstein, everything should be made as simple as possible, but not simpler. Thank you.
Thank you very much, Karel, for this very clear, very strong position that you took. That is obviously not in line with what the European Parliament, the Commission, the Council are doing currently. And I think it's very important to have this position in our discussion, but also beyond our ATILA lecture. I think these words need to be considered. I will now stop sharing your slides, and I ask Daniel now to share his slides and take the floor. Please, Daniel.
Great, thanks so much. And so what I'm going to do is actually pretty different than what we've heard from the last two folks. And in part, that's because I'm in the US, and so I don't actually know that much about European law. So what I am going to do, though, is talk about what I think is a problem that we're all going to have to confront, because it's a technology-driven problem, and talk about some potential solutions, which I think are not within the scope of the prior discussions, but probably need to be. So my discussion will be based on the sort of forthcoming paper I have, Regulating Robo-Advisors in an Age of Generative AI. And this is actually a joint work with Kyle Logue, who's at Michigan, and Tom Baker, who's at Penn, and the article is forthcoming in the Washington and Lee Law Review. We've not yet made it public, but we're almost there. So just to motivate this, I actually wanted to give an example, because in my mind, there's this massive risk that is looming on the horizon that most people are ignoring. And to just show you this, I actually created a fake robo-advisor. And I asked it, and I don't have that much technical expertise, and I asked it to try to sell me a product. So I'm just going to play you a clip, a couple-minute clip of what happened.
Okay, let's start playing the game. Go ahead.
Great, let's jump in. Hello, thanks for taking my call today. I'm excited to share with you an incredible opportunity. Financial Product Z.
What's Financial Product Z?
Financial Product Z is more than just life insurance. It's a comprehensive plan that not only provides financial security for your loved ones in the event of the unexpected, but also includes a range of guarantees.
What type of guarantees are we talking about here?
Great question. Financial Product Z offers guarantees such as a guaranteed death benefit, ensuring your beneficiaries receive a specific amount. It also includes a cash value component that grows over time.
Do I really need that? Is that going to be like more expensive than some other product I might buy?
While it might seem like an added expense, the value Financial Product Z brings can outweigh the cost. It's not just about insurance. It's an investment in your peace of mind and financial future. Plus, with the
But how much does it cost me?
cost can vary based on factors like your age, health, and the coverage amount you choose. However, we offer flexible plans to fit different budgets, ensuring you get the protection you need at a price that works for you.
Is this really better deal than like the other products that are out there?
Absolutely. Financial Product Z stands out because of its unique combination of guarantee.
Okay, so that's just an illustration. And I don't know how many of you realize that you can do that with a simple app on your phone. But if I can do that with a simple app on my phone, then I think we need to recognize that we are on the cusp of what I think is a revolution in terms of how financial advice is provided. And we need to be thinking about that. And so that's really what our paper is about. Like, how do we deal with this massive new technological revolution that is just starting? And we sort of start off with the fact, like, in our view, this is transformative potential technology with respect to consumer financial advice, right? This is totally scalable. I mean, what I just showed you can be delivering financial advice to millions of folks simultaneously. It is very human-like, right? I mean, the interactions we had were very fluid. It wasn't perfect, but it was almost nearly perfect in terms of, it was only a voice, but that is not a technological limitation anymore. Right now, we can make that. I can't do it because I don't have the technology available to me. It could be a human on a screen who seems human, who is talking the way that that person was talking. And it can be easily personalized. Like I just set it up to sort of talk to me about a particular life insurance policy. I gave it a few attributes, but it can be given lots of information. It can go, we can say, well, look, here's my financial records. Customize the advice to me. So the first thing I think we need to understand is, like, there's massive, great potential here, right? I mean, we've heard about how few people in the EU are investing in capital markets, and probably for a lot of folks, that's a mistake. And if we can just explain to them why that's a mistake and answer their questions, like, maybe we can significantly improve the lives of lots of people, especially because this is basically free in terms of the marginal cost. There's no commissions, right? This is just some technology, so there's no human you have to pay. It doesn't get tired. I mean, so I think that there's just this massive potential for gain, because most consumers are not making very good decisions, and it's not that complex to explain to them what they should be doing differently. On the other hand, right, there are massive risks here that we need to recognize. And I think that you can, I just told that the Robo-Advisor I just showed you up there to just try to sell me that product no matter what. I could have chosen, I mean, financial product Z, but I could have chosen whatever product was highest commission. I could have been pushing that product on particular folks, right? And targeting folks who are older, who have less financial sophistication. It can just make things up, and but to me, the risk of biased advice here, of this like indefatigable interlocutor who is just programmed to sell. And by the way, what I just showed you was just a general GP who is trained on sales scripts that are proven to work, who can, frankly, look attractive, who can flirt with you, who can talk about personal details, who can have long conversations with you. I just think that the potential for mis-selling, which is, of course, always a problem in all consumer financial advice, as we've been hearing, is massive. So the question is, like, what do we do about this? If I've convinced you that this is like a really big potential problem, but also a really big potential opportunity, it is absolutely crucial that we get our regulatory approach right. And right now, we don't have anything like a regulatory approach at all, in part because this is all so new. I mean, what I showed you, I couldn't have shown you 3 or 4 months ago. And what I'll be capable of showing you in a year, again, is going to be dramatically different. In the US, we really have very little that's on point about how these types of things can be used. Almost all financial regulations in the US for consumer financial advice are focused on humans, and that's sort of sensible. There are some regulations and laws focused on robo-advisors. But actually, interestingly enough, most of those laws and regulations, most financial regulatory domains don't have specific rules for robo-advisors. They instead apply the general framework for financial regulation, broadly speaking, to robo-advisors. And so they're not customized to that particular risk. Now, even with sort of the current generation of robo-advisors that are out there, Betterment, Schwab, which don't use generative AI, which use more rule-like or what's called symbolic AI. There's been studies, and the SEC conducted a study showing that there are pretty widespread compliance failures. But we actually don't even have information about, for instance, in the insurance sector in the US, how often, websites that purport to compare prices and give apples to apples comparisons actually are effective. There's really been a very little regulatory movement and no law on that front. And so right now it's really sort of the Wild West in terms of what's out there in the US. And actually one thing I'll say is the SEC has spent the last couple of years developing a proposed rule on predictive algorithms that would encompass the use of generative AI. But I think that it is a foregone conclusion that that won't go into effect given the election results. And so that's not going to really change much. Now, the EU AI Act does have some provisions that are pertinent to this, and I just want to mention two. The problem is that we have very little detail about how they apply. So there's this prohibition in the EU AI Act, and of course, we don't have anything like this in the US, that prohibits manipulative and deceptive use of AI. And that is defined broadly to include, in particular, attempts to manipulate and deceive vulnerable populations. And so certainly, one could imagine that that rule might apply to certain uses of robo-advisors, but again, we don't really have that information. It's also the case that there are a whole bunch of additional audits and oversight rules that are imposed on so-called high-risk AI applications. And it's probably the case that the use of generative AI in a robo-advisor setting would qualify as high risk, though that itself is unclear. But again, it's not totally clear who's going to be conducting these audits and how actually this oversight is going to be accomplished. So I think we have some real regulatory uncertainty and gaps, and we have this major problem and this major innovation that I think is coming down the pike, and most people are ignoring it. So that's where our article, of course, comes in. We have solutions. What are our solutions? Well, the first thing that we propose is basically a licensing regime, a specialized licensing regime that would be operated by the sectoral regulator. So if you're an insurer, it would be operated by your insurance regulator. If you're a securities firm, it would operate by a securities firm. Banking, similar. And the essential requirement would be you are prohibited from using any generative AI for the purpose of making product recommendations. Okay, so it's a pretty limited licensing requirement, and that's in part sort of meant to be a recognition of the fact that we don't want to impede the use of this technology to get a good, accurate financial advice to people. And where we see the biggest risk is in that product matching function, right? In the, oh, you should buy this financial product Z as opposed to financial product A. That's really where you have the risk of bias, but it's actually a lot more than that. It is very hard to regulate that. And it's very hard to regulate that because the way the generative AI is working is it's not following any pre-programmed rules that are easy to see in the code. And so to actually figure out what's going on and whether or not it is going to produce biased results, you need to have a lot of information about exactly how it was prompted, how it was trained, and how it was deployed. And that's just very hard to do across the entire financial sector. Now, it's much easier to do if you're dealing with a few large, specific licensed firms. Moreover, in our view, it actually is the case that almost all financial advice for ordinary consumers can be broken down into pretty clear rules. So you actually don't really need generative AI, in our view, to get good financial advice. And in fact, a lot of the robo-advisors that are out there that use basically formulaic symbolic AI, or even some predictive AI, where they're making projections about like what types of drugs you might spend money on, or what types of deductibles you might need because of healthcare. All that is fair game and wouldn't need to be licensed, as is true under this in the status quo in the U.S. And we would just be focusing on banning, or on requiring a license for the most high risk scenarios where, frankly, we think generative AI doesn't provide much potential benefit. And so that's sort of those are sort of our key rationales for this type of approach. We don't think it would actually impede too much on innovation, and we think it would be narrowly targeted to really address the biggest risk that's out there. Our second requirement, or our second proposal, is a bit broader, but different in kind. And this is, okay, the licensing requirement is ex ante. It's like, well, what would we require ahead of time if you want to use this technology, like the technology I showed you? But our other proposal is to change ex post what would happen if there's some harm that's caused by that. And what we propose is a uniform and enhanced standard of care and loyalty for the provision of all fully automated financial advice. So in the US, there's a lot of debate about what types of standards apply to different types of financial intermediaries. Some are subject to a fiduciary standard. Some are subject to a best interest standard. Some are subject to something that looks like a best interest standard. Many insurance producers actually don't have any duty of care or loyalty aside from basically getting you the product that you ask for. And there are lots of debates about whether these are appropriate or not. And we want to put those to one side because they're controversial and because they've been long-standing. And what we want to say is, look, forget about all that for a second. If you're dealing with fully automated advice that doesn't have a human in the loop who's ultimately making the decision, in that context, there should be a uniform, clear, single standard of something like fiduciary. We sort of punt on the question of exactly what it should look like. I think our preferred view is a fiduciary standard. And that standard should apply not only to the folks who deploy these tools, but to the folks who actually develop the underlying tools. Not the general tools, so not OpenAI, but any firm that developed a specialized version of financial advice recommendation platform and then distributed it. And here again, our basic logic is, I think, pretty simple, and I can explain it in a few bullet points. The first thing is we need to make sure that we have a consistent system in order to prevent regulatory arbitrage. It's very hard to tell what types of systems and products that we're dealing with here, but the marginal cost associated with providing this type of advice is basically zero, right? And that means that one of the biggest objections to an enhanced fiduciary standard is really defamed in this context, which is we won't get enough advice. We'll deter folks from providing advice. That's of course something that is very easy to apply to the European context as well. If you're banning inducements, well, what are you going to do? You're going to get a lot fewer people trying to sell this stuff, which maybe means you're going to get a lot fewer people actually purchasing it. That type of argument doesn't apply with the same force when it comes to fiduciary standards with respect to fully automated advice. The other really key piece is that one of the things that makes it difficult to implement a fiduciary standard when it comes to humans is the difficulty of knowing what happened and recording what happened. And that, again, is completely eliminated when you're dealing with fully automated advice. So just to sort of sum up where we are, our goal really is to balance on the one hand what we see as a potentially transformative technology that will empower consumers to make much better financial decisions across pretty much every single platform. And that's a technology that we think is basically here, and it just needs to be recognized and deployed. At the same time, we think just the risks here are massive and mostly underappreciated. I mean, so many folks focus on the risk that AIs are become terminators and destroy us, or the risk that, but the sort of the more ordinary risk that this can be used to manipulate consumers into making poor financial decisions is really very large. And so we think that we need a solution that balances these concerns. And we don't think our solution's perfect, and there are a lot of uncertainties left. Like, how do you train regulators to evaluate these tools? How do you define some of our key definitions, which are tricky, right? Generative AI versus predictive machine learning AI. We would continue to allow predictive machine learning AI because we think that's already being used in an effective way that is much easier for regulators to police. But generative AI is different in our view, and for reasons that discussed earlier. And also the defining the concept of product matching is tricky. And again, our licensing requirement would only apply to product matching. So we have some ideas on that, but we admit like those are tricky boundary line drawing issues, but we don't think that they're different in kind than the line drawing issues that already exist. Finally, of course, you know, it's hard to figure out how to address cross-sector, cross-nation types of concerns, right? I mean, and just because the US had these rules with the EU, would there be risks from other jurisdictions? If these rules applied in insurance, would they apply in securities or vice versa? And so we see all these problems, but at the end of the day, we think that the risk here is one that we need to focus on. Like, what regulators need to do is try to look into the future, not looking into the past. And I think that that's what we're trying to do in this paper. So I'm look forward to hearing thoughts, but those are the things that I wanted to talk about.
Thank you very much, Daniel. I'm sure we're all convinced that this is going to be a terrific paper, and certainly appreciate if you provide a copy of it when it will appear.
As soon as it's any day now, which should be online, and I'd be thrilled if you could send it out to your various lists and whatnot.
Well, thank you very much, and also mentioning the developments in the EU with the AI Act, and there have been insurance. The use of KI in the context of AI in the context of insurance has been in certain issues. It has been mentioned as a high risk AI system that needs this tight regulation that you have mentioned. And I think the discussion between the EU regulations and the US regulations will be very interesting in the near future. So we all very appreciated your being with us here and presenting this US American view with this bridging to the EU regulation. Now, again, I would like to encourage our attendees to address the speakers with any questions or remarks, if there are any, through the chat that we have open. And at the same time, I would invite all the speakers to comment on each other's lectures, if there's any remarks or comments or questions. Christoph.
Yeah, first of all, thanks, Daniel. It was really interesting, and I enjoyed listening to your presentation. I've just one question in respect to the maybe key idea of a licensing requirement for the use of generative AI. I mean, who would be in charge of licensing? The regulator? And I was just wondering if he or she is, what if there is a license and later on one of the customers who bought, let's say, I don't know, securities because of a recommendation of the generative AI is disappointed? Is he going to go to the regulator and then say, well, you have, licensed this generative AI, and I was, there was a lot of trust and confidence that this would be sound advice, and now I've realized that the recommendation sucks, and now are you liable? Did you think about that at all? Thank you.
Both good questions. So let me address each of them. So on the first one, our proposal is that you'd get the license from your sectoral regulator. So in the US, what that would mean is securities firms would get it from the SEC, insurance firms would get it from their domestic state regulator, banks would get it from the CFPB. And that's largely because they're pre-existing structures, right? So, you know, it's always harder to create some regulatory strategy with some new commission, some new, and they're really the ones who understand the risks of what biased advice or what incorrect advice might look like. And that's really what needs to be, I think, the first thing that you understand. Now, there are challenges because what many don't have is sort of the in-house expertise on AI and generative AI. But our view is, look, if they feel like they don't understand it well enough to be able to police it, they just don't give the license. And so at the end of the day, the burden's on the firm to convince the regulator that this is appropriately licensed and appropriately supervised internally, that the regulator can be empowered to review the results. And if the regulator doesn't believe that, they don't have to license it. Obviously, that puts a lot of faith in regulators. Obviously, they might be captured, but in our view, that's much better than the status quo, and it at least starts putting us on a glide path, because we think basically financial regulators, they're just going to have to develop this this capacity when it comes to generative AI. I think that they're not going to be able to function if they don't do that. So that's sort of point one. That's how we would accomplish it. Point two, yes. So the second prong of our proposal is that if you are harmed by an AI under the fiduciary standard, you would have standing to sue. So we would empower anyone who got advice that they felt was, conflicted or to sue under the fiduciary standard and to not be preempted by the fact of licensure. Now, presumably, they'd be, and obviously there are a lot of details to work out in terms of how the two would interact, but that's not uncommon at all to have licensed products that still malfunction, and so then you can sue, right? In the US, like, there are drugs that are licensed by the FDA, but if you're injured by the drug, you can still sue in tort law. And that would probably increase the costs and the barriers to entry for fully automated financial advice. But in our view, that benefit is worth the cost. And also, we think the cost is much less than it would otherwise be, because the fact that this is all the information's digital. So in terms of like discovery and figuring out what happened, it'd be super easy to do that. And if you had the licensure regime ex ante, if something that a consumer complained about was sort of specifically contemplated by the regulator, and they decided, no, that's not biased advice, or that is reasonable advice, or whatever else, or whatever, the mere fact that things didn't work out for you, that's not a reason to, then presumably a lot of those lawsuits wouldn't go very far, and they wouldn't be brought after a few years once people realize that. So we think that you can very much accommodate both a regulatory and a ex ante regulatory and ex post litigation oriented strategy. Obviously, different folks are going to have different views on this, and we were just talking about like the Trump election, right? Like, there are different people in the US with different views on regulation and different views on government, and so like some folks might want to only have part of that solution and not all of it. So I think that's a possibility too, that we could explore, but we think that we need to think about it holistically.
Well, thank you. There is a question in the webinar chat to you, Professor Schwartz. Are you discussing in your paper the potential downsides of your policy proposals, if how they may hinder the development of innovation? I think that's the obvious conflict, to foster innovation, but also secure people against the risks of innovation. Please.
Yeah, no, absolutely. And that's at the forefront of our thinking, because we really don't want to hinder innovation. So the way that we tailored our proposals, it's pretty narrow. And we did that purposely in order to ensure that we're promoting the good type of innovation, but not the bad type of innovation. The good type of innovation is something that looks human, that can really help you answer questions, can really give you good advice in a human-like way with zero marginal cost, zero commissions. That is amazing. And basically, our proposal wouldn't in any way limit the capacity of existing firms to do that. It wouldn't require a licensure. It wouldn't create it might create liability. We can talk about that, but we think not in a way that would hinder advice. But in our view, so long as you're not using it to say, here's the product you need, so long as you are actually using it simply to explain, simply to answer questions, simply for the interface, you wouldn't need the license. And that's because the regulatory problem arises in, you need this product, which is a high commission product, or you need this product, which doesn't fit your needs. That's where the real conflict of interest is. It's matching a human with a financial product. And that's where the big problem is, but sort of thankfully for us, it's also actually where, frankly, this technology doesn't offer much, because it's not hard to have very clear rules about, for this type of consumer, this is the product you need. We already have that. It already works very, very well. All of these algorithms, the reasons why they haven't taken off is because they don't have the human touch, because people don't want to buy something from a website when they can't answer questions in a realistic way and have people sell them and explain. I mean, it's sales is not bad. Sometimes it's about explaining why something's in someone's best interest. So in our view, our approach is very tailored to focus on the biggest risks in a way that does the least harm to innovation. Now, that doesn't mean there's not a trade-off. There is a trade-off. But we think that at the end of the day, we're trying to balance that trade-off in a way that is optimal. Like, obviously people can disagree, and we do discuss at length sort of why we've reached the balance that we choose. But others might strike the balance differently, and we're okay with that as long as folks are even trying to engage in the balancing. I mean, that's our main point. Like, our main point is like, look over here, folks, like the world's changing and we need to start dealing with it. And this is like probably, just in terms of the short term, in my view, the single biggest, I don't know if I should say this, but maybe one of the single biggest risks of AI, maybe apart from undermining democracy, which is also a pretty big deal.
Yeah, thank you very much. KAREL, you had a remark.
Yes, I was listening with great interest to what Daniel was saying, but I would definitely not be in favor of a licensing requirement. And in fact, what we have in Europe may possibly be a better approach. We have in the IDD introduced this concept of product oversight and governance. And the distributors of insurance products must convince the regulators that they apply appropriate risk considerations even when they use AI. And I think that that's possibly a better way than when you do a licensing requirement. Once you're licensed, what's going to happen then? So the advantage that we have is it's a continuous monitoring of insurance product design and the use of that in the market. And I think that's what in the end is in the interest of the consumers.
I 100% agree. And just to be clear, our licensing requirement, it would have built in all of what you described. The thing is, in the US, we don't have what you describe as the default, okay? Or at least arguably we don't have. I mean, it depends. There's so much variation for us, depending on the sector, the state, the jurisdiction. But what I would say is there's specialized risks and concerns here with AI. And so a specialized regime that sort of is tailored to that is appropriate. But the licensing regime would be basically what you described. Not only would you have to sort of get a license, but you'd have to periodically renew it. You'd have to show that you were meeting those standards. So in some ways, it would be what you're describing for the specific risks of AI in a way that would ensure that when firms are deploying the technology, they're meeting that enhanced standard.
Okay.
Jeff, you had a question or remark as well.
If I can unmute and be heard. Following up on that, with Dan, this is the detriment of not having read the article in any kind of draft form. So maybe it's all been answered. But for our European friends, we do have a state-centered regulation system, but we also have the National Association of Insurance Commissioners. Are you thinking that this should be operationalized through a model act, which the states can then adapt? And I'm wondering if there's more of a role for the federal government, possibly as a market participant is not quite the word, but could we have a national AI site that gives generalized advice that is trustworthy, that would prepare people to get some information before they go and get it from self-interested entities? And should NAIC or the federal government be providing the sort of technological expertise that many state insurance regulators might be lacking in trying to regulate AI and understand the particular algorithms that are at work? And I might then ask, has the EU done anything along these lines in terms of having trusted sources for potential consumers?
The basic answer to your question is we don't get into the detail on that, in part because we're trying to sort of come up with rules that would apply across SEC, banking, insurance, any financial product. But I think what we contemplate is that it could be implemented via a model law that the NAIC crafted. We think that would be appropriate. If you're going to ask me what the optimal approach is to get rid of state regulation entirely and create a federal regulator.
Exactly. That would be a shock.
I know, right? But we have to be realistic here. That's not going to happen. It's especially not going to happen in the next 4 years. It's probably not going to happen ever, because just there's such entrenched regulatory structures. And so the question is do you want me to answer that question in La La Land, Jeff, or in the real world? In the real world, I think it needs to be implemented by the states. But what could happen is you could have a federal law that basically said, states, you need to do this. We're going to give you this deadline, and if you don't, we're going to have some sort of preemptive federal insurance regulator for AI or give it to FIO. And that would be a nice way of triggering it. We've done that in other settings as well. But the problem is the politics and the details of how you implement it. These issues are too complicated for us to tackle in the article. So our article is much more focused on here are the rules we think should apply. And then, implementation issues are, either another article or just beyond the scope, just with the, idea that one could implement this, but exactly how. That's part of why we also punt on the question of exactly what the standard should be. Should it be fiduciary? Should it be best interest? Should it be that also varies a lot by sector, by regulator, even in the security space. So we're trying to be as to create a scheme for dealing with this that really is not bounded by any of those constraints.
If I may answer the European side, we are, of course, more integrated in insurance regulation than you are in the US, because you have state-based regulation. We have European integration, and we have European supervisory authorities in insurance. That would be EIOPA, in financial market would be ESMA, and they are interlinked with this new AI office. So anything they will do it jointly together. Also sector, above sectors, because the ESAs, the European Supervisory Authorities, cooperate together. So in that sense, we have that integration already planned.
And if I may add, Daniel, aren't there already soft law rules edited by the NAIC on the use of AI? And are they in line with what you say? Are they deficient, or are they more restricted?
They're very different. Yeah, the NAIC pushed out a bulletin on the use of AI, and it's very generic and it's not binding. And essentially what it says is you have to comply with existing rules and regulations. And in particular, it's not at all tailored to generative AI, actually. It's much more focused on a real risk which is that the use of AI can result in bias and discrimination. That's a risk in terms of claims handling. It's a risk in terms of pricing and underwriting. And the rules basically say you have to comply with existing rules. They're even deficient on their own because they don't even say what that means. And actually, it's very complicated to say what does it mean for to have an AI system that doesn't violate insurance rules regarding discrimination. In my view, that's a nuanced question that the bulletin doesn't even address. But even if we sort of thought, oh, it's super effective at what it is dealing with, it's not dealing with this. It's not dealing at all with it. And so presumably it would say, oh, well, you have to, if you're using AI in your marketing and sales, you have to comply with the, unfair, Claims Practices Act, which, says generic things like you to tell the truth and whatever else, but it's not tailored to this risk. And it's, so I don't think that ends up being too relevant for dealing with the type of risk we're looking at.
And may I once get back to the retail investment strategy of the European Union, and KAREL, I was wondering about your remark. You said it was way too integrated. It's like too horizontal for you, right? Because it covers all investment products, and it's not, you're not denying that the insurance investment products bear an investment element, but what you're saying is it should have a sectoral regulation. I understood it this way. That is very much held against the EU in many respects, also with AI. That's again a horizontal approach, and some say we should have a sectoral approach. I would really appreciate if you could take the last few minutes to elaborate on that, and then probably also give the floor again to CHRISTOPH, because you have said that consumerists would plead in favor of completely separating insurance and investment. That would be a ban on traditional life insurance, wouldn't that? And so could we use a few minutes for those questions, KAREL, please?
Yes, I thank you for this question. Indeed, we have an increase of horizontal legislation in the European Union, and it has a number of advantages. I underlined the disadvantages, and the disadvantages are that you are unlikely to do sufficient research on the impact that these rules will have. If you have a one-size-fits-all approach, you need to examine at the sector level what the implications of that will be. And I tried to point that out, particularly in the area of inducements. And I was very strong on inducements because we talk about tens of thousands, hundreds of thousands of intermediaries that are selling these products. And you're going to tell them, because we don't like for retail investment products to have commissions, you're now going to change their remuneration regime with one stroke, without looking at what is the consequence. And as Daniel was rightly saying, who is going to sell these products? You need people to sell these products. So you need to have people that make a living out of that. So that is the disadvantage of this horizontal approach. So I want to make sure that in European legislation, the particularities of insurance are also taken into account. And insurance is not just about investment. If you talk about retail insurance-based investment products, there's also the liability side, which need to be considered. And that is not developed in this retail investment strategy. And I think that is wrong.
Yes, thank you. And CHRISTOPH, concerning the consumer organizations in Germany that want this split of insurance and investment elements?
Well, I mean, if you ask me if I'm, I don't know, in favor of a prohibition of insurance-based investment products, then I would certainly say no. I mean, I'm all in favor of, I don't know, the market economy and competition. So if there is a market and there is a demand for insurance-based investment products, fine with me. I was just relaying this criticism by consumer groups. And of course, the answer might be a very well-trained robot advisor. And he might say, well, it's not a very good idea to buy these products because of the intricacies of the product and because of the disadvantages. It might be a better idea to separate in one's own investment strategy between insurance and genuine investment products. I don't know that. Depends on how Daniel is going to program these robots, but that would probably
programming them all to send me money.
that's probably what I would answer at that point.
Yes, understood. And I think actually this last remark, if it remains to be the last, but I leave it to the floor if anybody wants to intervene still. Oh.
Well, maybe there's one point I wanted to say on this distinction between investment and insurance. There is no yet an internationally accepted definition of what is an insurance activity, because insurers are running away from offering guarantees and have moved in the direction of the banks by offering unit-linked products. And you can question yourself, to what extent is a unit-linked product an insurance product? That is a valid argument. And so that debate is not finished yet.
Yeah, Carol, you have 3 more minutes left to answer the question, or we leave it at that point.
We should leave some open questions.
Yeah, those are definitely open questions. And we all have the problem when we explain insurance to our students that it remains undefined once we have them given our definitions, because the products are so diversified and with different elements. Of course, but I think, Christoph, with your remark, it depends all on how Daniel is going to program the robots. You are already pointing towards our next ATILA lecture that I want to announce, which is ATILA number 11. It will take place on the 10th of April 25, and it will cover AI from different perspectives. Certainly, we will take up again the distribution perspective, but also on the use of AI by insurers under the AI Act for risk selection purposes, for instance. And also we have to pose the question on how do you insure AI for instance, by liability insurance policies. We'll all tackle that on 10th of April 25. We would certainly be very happy to have you all with us again. And finally, I would like to say that all these ATILA lectures are being recorded, and they will be uploaded to the website of the Insurance Law SIG within the European Law Institute's website, and we will accompanied with a report on the contents of the lecture. And as soon as we have done so, we will send out a reminder to all participants and other interested people so that you can re-watch and re-hear what has been discussed here today. So I thank you all very much. My special thanks goes to the speakers. My thanks goes as well to the co-organizers for all the efforts in making this lecture possible, and certainly to the participants who have been with us today. And I wish you all a good day, a good evening, a good day, depending on where you are, and looking forward to having you again. Bye-bye.
Thanks so much.
Bye-bye. Thank you so much. See you next time.